Mantesh joins us now. Let's take our conversation forward with him. Mantesh, Reliance, big comeback. Is it because of underperformance or markets expect something different from earnings this time?
So firstly, a disclaimer, I own Reliance as a stock, but I think the moot question that when we look at Reliance and try to answer is, what is the likely CapEx program going to be ahead with the upcoming 5G auctions coming up? As you're aware, telecom has become an important vertical for Reliance lately. The energy vertical is fairly steady. Any changes on the energy side doesn't really impact, I would say, the stock movement. Whatever the outperformance we saw for Reliance during the pandemic period was, I think, attributable to the telecom vertical, and the upcoming 5G auctions is going to be an important event. And therefore, we will be looking at what's likely to happen to the 5G auctions. The 5G auctions are about to be taking place, and therefore there will be strategic moves that will be happening across the industry. Reliance will be wanting to take some some stance there now, and therefore probably the price is taking that into note and recovering a bit in the market lately.
Do you expect something good to hear from Reliance about their old economy business? When I say old economy business, GRM, petrochemical margins, naphtha spreads. Do you think one should be focusing on that? Because if commodity complex is in some kind of an overdrive, obviously a petrochemical company like Reliance or a petrochemical giant like Reliance would benefit.
And I did mention that while energy vertical is fairly steady, it doesn't move the needle for the company now that the stock has rallied so much. The valuation of Reliance used to be single-digit EV EBITDA multiples not too long ago. Now they have moved into double-digit EV EBITDA multiple. If that's the way one looks at Reliance, there are other ways also that in a way which you can look at Reliance from a valuation perspective, but the standard EV EBITDA multiple has moved into double digits, and that has not happened because of the energy vertical. Now that double digit EV EBITDA multiple will not move much, even if there are, let's say, expanding GRM margins on the refining side, or let's say the petrochemical margins also stand to improve. So in such a situation, I would say that with that business being steady, the good part of that business now is at least there are no worries on the demand side. Now that the recovery has happened, we have seen that the petrochemical consumption in India is well above the pre-pandemic levels of last year. And there is growth ahead. So that's India, and something similar is happening across the globe. So to answer your question, I don't think petrochemical or the refining businesses is something which we should be looking at with renewed focus as far as Reliance is concerned when it comes to taking a call on the stock.
Fair point. Nuresh, where is Reliance headed? It is moving today it is moving closer towards 2000, but where will it eventually settle? Above 21, do you think it will go towards 2100 or it will go back towards 1800?
That Reliance, I think, should be headed towards 2200, 2300. I think it's now a matter of time. I think it's not a matter of if, but it's a matter of when that that the stock would make a comeback. Now, I for one believe also that the market has shown that in this last 6-8 months, all of these stocks have gotten a second chance. So whether it's Bharti Airtel, whether it's UPL, which is also making a comeback, Bajaj Auto, Hero MotoCorp. There's so many stocks which have from their swing highs, they've fallen 10%, 15% odd, and then managed to make a strong comeback. Now, in that context, you can expect that Reliance Industries, which from 2,350 odd, has come back to 1850, 1900. It's taken some time to consolidate over here. The last 2 weeks of delivery, set of volumes, the delivery data for Reliance Industries was extremely encouraging. Now, when you look at all that backdrop on how the market has performed and the context of delivery data for Reliance Industries, it indicates that there is a strong possibility that probably post-result, the stock may start to outperform. So I for one believe that Reliance Industries, till the time it holds on about the 200 moving average, I think should move back about the 2100 to 2200 zone.
Okay, talking about Reliance running up ahead of its numbers, let me take it across to Vivek, find out what Bank of America has to say about the 3Q earnings this time.
Just as we enter the thick of the earnings season, remember, a lot of Nifty companies would be coming out with their earnings in the coming 2 weeks. IBFDA Securities has released their preview report as far as Q3 earnings is concerned. Now, what they're saying is that the erosion of profits that we saw in the past 2 quarters has come off quite significantly, as most of the companies under their coverage has actually managed to weather the COVID storm quite well. Now, what they're saying is that they're expecting Nifty earnings itself to grow 4.5% on a year-on-year basis, and on the back of the fact that if you exclude financials, they're actually expecting close to 5% year-on-year earnings growth for Nifty companies. What they're saying is that within the Nifty, they're expecting materials, telecom, consumer discretionary. These are the top 3 themes that they believe could actually go ahead and outperform. On the other hand, what they're saying is that PAT erosion could be quite severe as far as energy and industrials are concerned. But the one sector that they have in focus is the Indian steel company sector. What they are saying is that they are expecting steel companies to report a very strong profitability rebound, supported by very strong domestic steel prices, and on the back of the fact that spreads for most of the steel companies have expanded quite significantly. The other sector that they believe could actually surprise positively is the telecom space. They believe that the relaxation in the one-off AGR dues could actually lead to losses previously. Now, what they're saying is that some of the companies that could disappoint is SBI, HDFC Life, Bajaj Finance, ONGC, IndusInd Bank, while Hindalco, Tata Steel, JSW Steel, Bharti Airtel and Axis Bank are the ones that they have pegged for a very strong earnings growth in this particular quarter.
Okay, Vivek, we'll leave it at that. In fact, take it across to Varun as well. Find out what brokerages have to say about HDFC Bank, which delivered an impressive set, managed to beat all street expectations when it declared its third quarter numbers over the weekend. Varun?
Well, it doesn't come as much of a surprise that brokerages maintain their bullish stance on HDFC Bank post the earnings we saw on Saturday. We have Motilal Oswal with a 1720 target on the stock. They see strong business momentum continuing, very stable asset quality, and they believe that in the event of any near-term stress, the bank has made enough contingency provisions. We then move on to Jefferies, who have a higher target of 1800 rupees on the stock. They really like the retail franchise gearing up at HDFC. They see NIMs expanding, limited asset quality stress, manageable slippages. The only drag they really flagged off was HDB's performance this quarter. Other than that, with collections returning to normal in the pandemic year, they maintain a bullish stance on the stock. Finally, we have CLSA with the highest target of 1825 rupees per share. They reiterate their positive view not just on HDFC Bank but also on the private banking pack. They believe there's a huge positive surprise in asset quality. They're upgrading their earnings estimates by 4 to 6%, and they really like the strong momentum in core PPOP growth, which has once again shown a strong show this quarter. So all 3 views we discussed, fairly bullish on HDFC. Let's see how the counter opens in trade.
All right. Mahantesh, we were getting some positive views on the auto Ank pack and how, we were looking forward to this revival coming in. Some of these companies actually meeting those higher production targets in 2021 and that the worst is now behind us. Are you as optimistic on that front?
Automobile companies have done quite well. I would say they have delivered a surprise on the positive when it comes to their production and a quick recovery at that. The year ahead, despite the challenges on the cost side, we know that metal prices are up. So there's an opportunity for the companies now to raise their prices. What I mean here is that in a situation where the demand is now become buoyant, you have that ability to raise prices. I'm sure most of the automobile companies will be taking this opportunity. around the budget time, because they will await what the real budget proposals would be, particularly related to the automobile companies, and then take a price hike. Mind you, there is also an expectation about automobile companies looking for lower incidence of taxes. While GST is not a subject that can be touched upon in the budget, the cess that is levied on automobile companies is something that can be reviewed favorably, and that pushes the prospects of automobile companies for the better. Irrespective of that, the demand, as you would notice, is fairly strong. And when you have started now delivering double-digit growth in a pandemic-affected kind of economy, most of the automobile companies will do well. And when there is so much of liquidity there in the market, quality is the first corner where all that liquidity will accumulate. Automobiles do exude quality when it comes to their earnings.
Okay, so that's on auto. And Kunal, if we take a look on the charts today, we are seeing some pressure on an Ashok Leyland, Tata Motors, also names that have actually run up quite substantially of late. So, where would you be when it comes to chart activity or a good entry level for some of these auto majors?
So I think if we specifically look at, I still believe that there's one stock which looks attractive even at current levels, and that's Bajaj Auto. I think at 35.85, 3600, where it's currently trading in the spot zone, I think it looks attractive for another 150 to 200 points on the upside. So as a short-term, trader, one could look at least a 5% kind of an average upside from current levels. But then when you look at the other auto stocks, I strongly believe that Eicher Motors and Maruti are the other two names which have relatively a lot more potential than what they've shown the last I think at least 2-3 weeks, if not more. So on charts as well, Maruti had hit back that 8,200, 8,300 mark. From there on, the stock has scaled down at least 200, 250 odd points. Eicher Motors, very similar kind of a chart. The stock making a high approximately at 2,900, and then now falling by almost 100, 150 odd rupees before it manages to bounce back. So I, for one, believe that Eicher Motors and Maruti from current levels as well look very attractive. And the best part about the auto stocks is that the concentration and the trend is so strong on the large cap space itself that if these stocks itself moves up higher, it gives a push and a leg up to the other the mid cap and the smaller or the tier 2 denominated stocks in this space. So I think Eicher Motors and Maruti could be the other stocks. Bajaj Auto from a trading play looks attractive at current levels for at least 150 point on the upside.
I'm looking at Maruti, Tata Steel. Nothing in the PSU space today could be called as charged up. Maruti is not a PSU stock, but I'm just using that for reference. The advanced decline ratio is not favorable. So for the first time, we've seen 2 or 3 days of little bit of give and take, which clearly seems to be happening. Incredible strength in IT. When I say incredible strength, this is one space which was outperforming for the better part of December, early part of Jan. Numbers have been solid, and the follow-up really there seems to be moving. Mahantesh, again, I'm going to ask you to comment perhaps on a source-based story. We heard that tighter norms for NBFCs are coming, and NBFCs could be regulated, something which the governor also referred to over the weekend. Where are NBFCs headed? If tighter norms are coming, could that impact the cost of borrowing, cost of operations, NIMs and spreads for wholesale NBFCs?
So one of the distinct feature of NBFCs relative to the banking space is that they enjoy higher NIMs. Along with higher NIMs, of course, they have also higher level of NPAs. And therefore, if tighter norms do come and RBI tries to look at reining in the buoyancy around the financial services companies, including NBFCs, probably what they will do is tighten the provisioning norms, and not just that, they will also look at introducing some caps on the interest rates that can be charged. So basically in the form of spreads. So these two basic ingredients of any NBFC, which is NIMs, that is larger or wider NIMs, and on the other side, the higher NPAs is something which will hurt the NBFCs going forward when NIMs drop and NPA levels are tightened. That means more provision will be called for. Because remember, not all NBFCs are really well capitalized. They always struggle to raise capital. Not only that, even when it comes to raising the capital on the debt side, that is it becomes a little difficult. Look at some of the NCDs that were recently opened up for subscription. They did not get great deal of subscriptions or over subscriptions, I would say. And that tells you the story in part about what's happening with the NBFC space. So I would reckon that source-based or otherwise, NBFCs will gradually have to yield to better and tighter controls, better management and tighter controls. So I think that's a journey that has to be completed, and it may happen sooner or later. I wouldn't say that. I wouldn't take a call and say it will happen just because RBI talked about it, so it will happen tomorrow or the next month and so on. But it is on the cards, and it is the journey that will happen, will get completed.
Let's move on. And given that it's just 2 weeks left to go for the union budget for the year, here's an ET Now exclusive. And it's a budget cover. Finance Minister Nirmala Sitharaman has received several proposals to give a booster shot to housing, which has a multiplier effect. So my colleague Nayantara Rai joins in with more details. Nayantara, what is being discussed when it comes to housing?
First up, what we understand is to really put more money in the hands of consumers. That's going to be a big theme that you're going to see perhaps overall in the budget. So rental income is what we understand the budget could look at giving a boost to, because the minute you do that, you might bring buyers back to the market, you might bring corporates back to the market. How can that be done? Let me put it to you very simply. Right now, when you as an owner of a house put it on rent, you get a standard deduction of 30%. On that balance part is what you pay income tax on. So if you're in the highest bracket, you'll pay 30% income tax on that portion. The idea is to give an impetus to that and increase that standard deduction from 30% to 50%. So you put more hands in the money of the landlords, but the idea being that it's such a significant amount that you could bring back corporates to this space. Remember the good old days when the Reliances, the ITCs, the L&Ts of this world would actually provide housing to their employees. That seems to be the idea, because when you do that, maybe you'll pick up unsold inventory, you could give orders to builders. So all of that will have a multiplier effect, and that seems to be the big theme, the policy changes that can be introduced, which will have large effects. So this is one such example. You give the landlord more income, you also give the corporates an incentive to come back to the housing sector, and the employees also gain. You've seen reverse migration that's taken place. The Prime Minister has time and again spoken about why is it that industry can't go into newer parts, and this could be a great incentive to do that, right? If you go into newer parts, you look at reverse migration, you put up housing. So that seems to be one big idea. The second one has to do with the corporates, the commercial real estate space. You don't really have any accelerated depreciation concept at the moment. The minute you introduce an accelerated depreciation concept where your building depreciates faster, you'll get tax rebates as well. So that seems to be the second idea that is there before North Block. The third one is one you hear about every year, which is to increase the tax rebate on home loans. Right now, it's 2 lakh maximum on the interest component. The idea being, once again, give an incentive to people to go out and spend more money, boost consumerism, all of that.
Nayantara, we'll leave it at that. Mahantesh, wanted to get your sense in on what could the budget really do for beleaguered sectors which are under stress, such as housing, although some of the states have taken incentives or some measures like Maharashtra and managed to boost their residential sales at least. But what about other sectors like hospitality, like aviation? Are there heightened expectations from the budget for these sectors?
I think it will be a very difficult task for the finance minister to balance the budget this time around when the buoyancy in tax revenue is not not really good. So the first thing she needs to look at is how is it that she can increase the tax buoyancy without really taxing the general public or the industry as a whole. The tried and tested method, which the FM in the past has also done, is actually reduce the marginal rate of tax. That's one way to do it. Or the other way to do it is without really reducing the marginal rate of tax, look at reducing the multiple levels of tax slabs that exist, particularly on the personal income tax side. So if that is simplified, you will have better tax compliance, and therefore tax buoyancy will follow through. So more than really giving incentives in the form of, let's say, an extra allowance for an XYZ thing, that allowance could be related to some consumption item. It could be housing consumption, it could be car consumption, it could be something else. I think the better way would be to build in tax buoyancy, that's a long-term measure, through simplification of the tax slabs or the tax rates itself. I guess that would be one method that will really help boost demand.